So, it's settled. U.S. President Joe Biden has nominated Federal Reserve Chairman Jerome Powell for a second four-year term. Mr. Powell is well liked by both Republicans and Democrats and is expected to sail through his Senate confirmation. But there's also a sense of unease among both parties about how the Federal Reserve is managing interest rates as U.S. inflation hit a 31-year high in October. Mr. Powell will have his work cut out for him to keep long-term inflation expectations anchored. From cars to energy, from furniture to groceries, American families are shelling out more cash as they experience an across-the-board rise in prices. Gas prices, for example, are so high that Biden had to release a record 50 million barrels of oil from America's strategic reserves in an attempt to ease energy costs. Although the U.S. president himself admitted the move will not solve the problems of high gas prices overnight. Relative to other G20 countries, the United States is seeing one of the fastest increases in prices. Mr. Powell believes that inflation is transitory, although that remains to be seen. The Fed has committed to keep interest rates near zero until inflation increases above 2% and when the labor markets return to maximum employment. Inflation is now well above 2%, rising to 6.2% on year in October. But there are still 4 million less Americans employed now compared to pre-pandemic levels. The Fed doesn't want to raise rates too soon to tame inflation. It's concerned that doing so at this stage would jeopardize the labor market recovery. But could the Fed be acting too slow on fast rising inflation risks? If the Fed doesn't budge on rates, does that mean American families will have to endure a longer bout of higher inflation? Inflation hurts the poor the most. Also, could a super accommodative Fed and a more relaxed attitude towards inflation now mean that interest rates may have to rise faster than expected and more than expected in the future to cool off inflation? Higher prices mean thinner wallets. The Fed's inaction on inflation is feeding through to President Biden's poll numbers. Mr. Biden's popularity is sinking with inflation at decade highs. According to Nate Silver's 538 presidential approval rating, which is a weighted average of every national poll on presidential approval, as of November 23rd, 52.3% of Americans disapprove of Joe Biden, the highest disapproval rating since he took office. According to a CBS News and YouGov poll, 2/3 of Americans disapprove of Biden's handling of inflation. If Powell and the Fed are behind the curve on inflation and is forced to raise rates more aggressively later due to miscalculation now, then that increases the risk of pushing the U.S. back into recession, roiling global capital markets, and undermining financial stability. All of that will certainly impact Mr. Biden's approval rating further and chances for re-election. The United States unleashed what's billed as unprecedented monetary and fiscal stimulus to combat the pandemic. Now the country is facing high inflation due to those blistering salvos of pandemic-induced stimulus, while having to deal with supply chain challenges and labor shortages. In contrast, although we also saw a strong monetary and fiscal response from China to fight the pandemic, these were not flood-like stimulus measures. They were more flexible, appropriate, and targeted. Add that to effective virus containment measures, and you have China's overall price level well within a controllable range despite a growing economy.